Hey, are you looking for a way to make some cash? Well, we know something that can help. With only a few dollars today, you can set yourself up for success in the future and allow yourself to retire comfortably. But there are a few things that you should know before you delve in. With the high reward possibilities that come from the stock market, there's also a plethora of risks. In this short video, we will inform you on the different aspects of the stock market to help you better understand the risk and rewards of the different methods of investing in stocks. There are many different types of stocks and ways to invest, but the few that we'll be discussing in this video are ETFs, dividend-paying stocks, short-term investing and the bubbling effect, long-term investing, and shorting. The first type of stock that we will go over is an ETF. An ETF is a collection of a small portion of many different stocks that can be bought and sold just like regular stocks. An example of an ETF could be the SPDR S&P 500 ETF Trust, which is made up of different companies like Microsoft, Apple, Tesla, and many others. ETFs have many advantages, and the biggest one is it allows you to diversify your portfolio. You invest a small portion into tens or hundreds of companies so that if one stock drops, it doesn't affect you as much as if you had all of your money into just one stock alone. And although ETFs are mostly positive, they do have a disadvantage. You may lose out on some of the money if a single stock in an ETF skyrockets compared to having shares of all in that company alone. The next type of stock that we'll be talking about is a dividend-paying stock. These are stocks where the company pays shareholders quarterly, and an example of this would be Apple, Microsoft, or Walmart. An advantage of this type of stock is you get a steady income stream from the dividends. A risk would be that the stock's share price could drop, and although you'd still be getting paid the dividend, you could lose out on money if it drops below the price that you bought the share at.
Short-term investing is a type of investing that is useful in some situations, especially if bubbling is involved. Bubbling is a period of growth in stock prices followed by a drastic fall. An example of this is in the early 90s, where every company with a .com at the end of its name was targeted by investors. Many did not have sound business plans, so it ended with them tanking in their stock prices. A reward for bubbling could come if you sold your stocks at the right time. If you were able to sell the stocks before the fall, then there's a lot of reward to reap, but that leads directly to its risk. If you hold on too long, the price could tank, leading to a loss of all the money you paid for each share. Long-term investing is just in the name. It's investing into stocks and then holding them over a longer period of time. This is one of the safest forms of investing because if a stock is trending up, then it will alleviate the random dips in the price, and it's stress-free since you don't have to worry about trading it. Though a con is it takes time and patience since you have to sit on the initial investment. Next, we have shorting. Shorting is selling a stock at a higher price and then waiting for the price to drop to buy the shares to cover. This method of trading can bring about huge returns if you are able to predict a stock's drop in price without having to invest in a large amount of money initially. But this method is also very risky because if you are wrong about the stock's price dropping, then your losses could be infinite until you buy to cover. The stock's price can continue to rise and you could get yourself into a lot more loss than if you had just normally bought and sold shares. There are many possibilities that can derive from the stock market. You can set yourself up for the future with just a small starting amount if you start early enough. Although it can be risky, by using your knowledge about the stock market to make educated trades, the rewards can be endless. So, what are you waiting for? Start today by going to a website like Webull or Charles Schwab and test the waters. Eventually, once you are comfortable, you can start planning for the future and watch your money grow.